Hey guys, TommyBryson here and welcome back to the channel. And today I'm going to tell you exactly how I managed to have my investments cover all of my bills. Meaning if I stop working today, my investments can pay all of my bills and I don't have to work. Now, if you are a complete beginner when it comes to stocks, this video is for you because I'm going to take you from A to Z, but you will walk out of here. That's my goal, knowing more than 90% when it comes to investments than the general population, because people just know stock market, investments, put money in and hope that you actually take money out and it's actually a profit. You're not going to be like that anymore. You're going to know exactly how investments work. It's going to be the first part of this video. I split it up into 3 parts. It's the same video. You don't have to go anywhere, but it's into 3 parts. The first part is going to be how investments work, what I invest into, where I invest my money, and how much money I invest. The second part is going to be all about how much money this actually makes me, what the risks actually are, and what history actually shows about this investment way. Don't let anyone lie to you and tell you that investments are risk-free. No, there is risk when it comes to investments, and I'm going to tell you exactly how to evaluate it and how to adjust for it. And the third part is going to be the best investment strategy that I found and the one I currently use right now in my personal life. Okay, so I hope you actually enjoy this video. I hope you watch it until the end, because again, you're going to know more than 90% of the population if you take on this information and you actually do what I'm telling you to do. That's my goal for the most part. Now, do me a favor and smash the like button on top out. Also, subscribe to the channel and hit the bell to get notified. Now, the very first question that I always get is, Tommy, what exactly do you invest into? My only investment is into the S&P 500, and that is an index fund. And with that index fund, I basically own a fraction of the 500 largest companies in the entire United States. So I own a small fraction of ownership in Tesla, in Microsoft, in Meta, which used to be called Facebook. In all those different companies, I own a small fraction. Now, the benefit of doing that is that basically, if I only had my money in owning a small fraction of Apple and Apple goes down and loses and goes bankrupt, I lose all my money. But because I have my money spread around these 500 companies, I'm going to be okay if one company goes down because I have 499 other companies that I actually have ownership in. Now, it's a very common question. What do I invest into? But it doesn't really do much for you if you don't really understand what an index fund actually is. So here are some basic knowledge that you should have as an investor, which is first, what is a mutual fund? A mutual fund is going to be a fund where a lot of investors pool in their money and you have managers that actually manage that money and they're trying to achieve a certain goals. You have 2 types of managers overall. You have one manager which is going to be passive and you have one that's going to be active. The active manager, they're going to try to actively manage your money and try to outperform the S&P 500 or some other index for the market, which is basically they're going to try to beat the market every single year because they're smarter and because they know what they're doing. Not really. A lot of them, they actually don't outperform the market, and that's why it doesn't make sense. And because they're buying and selling and buying and selling investments to try to outperform the market with your money and other investors' money, well, it's going to cost more to manage the fund overall, and is it going to have a lot of fees involved. So they might have, for example, fees of 1%, 2%, even sometimes higher than that. Now you might say, charging me 1% or 2% in fees of my portfolio value is not a big deal. The truth is, it is a massive deal, because if you make 8% from the stock market and they take 2%, taxes take 1%, inflation takes about like 3%, you're left with about like 2% or 3% for the most part. So that 2% takes about a third of all of your investment profit. So you don't want to do that. At least I'm not doing it. So passively held mutual funds, Those are going to be called index funds for the most part. And they're just trying to basically mirror the stock market's performance. So whenever I buy into the S&P 500, they're trying to mirror the performance of the Standard and Poor 500. Again, the 500 companies in the US, okay? So I'm not trying to beat it. I'm not trying to outperform it. I'm just trying to get what the market actually gets every year, which is just about 8% or so. So you have mutual funds, you have actively held ones, and you have passively held ones. So yes, an index fund is just another type of mutual fund, but it is passively held. And because it's actually being passively held, it is going to cost a lot less money to manage. So you might be charged like less than 1%. I'm talking about like 0.25%, 0.3%, 0.4%, and that's going to save you a lot of money. Because remember, actively held ones, they charge you more money for the promise of beating the market, but whether they do that or don't do that, they still charge you that 2%. So why would I actually be motivated to beat the market, which I don't, when in reality, I'm still going to get paid? Does that make sense? So that's why I do index funds. And I think you should too. Do your research though, and I recommend you read a book called Common Sense Investing by John C. Bogle. I think that book is great and will teach you everything you need to know about index funds and mutual funds, and also a little bit about stocks. Now, what exactly is a stock? Because it's very important you understand. When you buy a stock, you're buying a small fraction of ownership in a business. It isn't just, for example, a piece of paper or some digital currency, or for example, like a little ticker symbol that goes up and down. No, you're literally an owner of the company. So buying a stock doesn't just involve like saying, hey, the price is $100. It used to be $50. I think is going to go up in the next 10 years. If you can't base that observation on facts, then you are just speculating, which is just like a fancy word for guessing. And you don't want to do that because you are investing money for the long term and you can lose all your money. If you want to learn how to pick individual stocks, you're going to have to read The Intelligent Investor by Benjamin Graham. That video is going to teach you, or that book is going to teach you all about how to find the intrinsic value of a company, or a stock in this sense, which is basically saying how to value a company, because stock investors are just like business evaluation, okay? It's the same thing. You want to value a company, you want to know what it's worth, and you want to make sure you're paying a fair price. Everyone is just like guessing and gambling, but real investors, that's what they do. And that takes a long time, about 4 to 8 hours a day. That's why I choose not to do it. Now, you're also going to have to know what a bond is. Now, a bond is different from a stock, because a stock you buy, you know what the price is, but you don't know what the return is going to be. But a bond, you know exactly what the price is and you know exactly what the return is going to be. Because when you buy a bond, you're literally lending your money to a corporation, a state, or even a government. And that's just basically, I'm lending my money to you for a certain coupon rate or an interest rate. And that might be 5%, 4%, 6%, whatever it is that you're actually signing up for. Now, you have different types in the sense that you have, for example, bonds that are AAA and bonds that are very secured, bonds that are more risky. And with stocks and with investments overall, the more risk you take, the higher return you can expect. But the other side of risk is you lose everything you have. So you have to be very careful when you're trying to select bonds. Now, it's very important you know this, okay? The only risk-free investment that we have is treasury bonds. Treasury bonds are literally issued by the US government. Now, why is this risk-free? Because if they choose to default on the entire like bonds, it means that the government is done. We lose all credit worthiness as a nation, which at that point, it is insanity. But even then, you have to remember the government has the right and the ability to literally just print more money. So it's like saying, I can always pay you because I can always make more money. Now, that doesn't mean it's not going to affect you. I'll talk more about that later, but it's the only risk-free investment we actually have. So when you are investing into stocks always have to be making more money than bonds because they are riskier than bonds. So a way to kind of evaluate if it makes sense investing into the market or not is if you have, for example, bonds are paying out 5% and then stocks are like giving you like 4% and it's not that much money like at all, well, it's riskier. So I rather buy a bond. Don't believe the hype that it never makes sense to buy bonds, that it always makes sense to buy stocks, okay? So that's not true at all. I recommend you read a book called A Random Walk Down Wall Street. That book is going to teach you why stock selection is very risky and why you might not want to do it. But even reading, for example, The Intelligent Investor will give you some information when it comes to bonds. Bonds may make sense for your investment portfolio, and I'll talk about it later in the video. Now, you may be curious why my only investment is into an index fund and why it's my way of investing. The truth is, I am a passive investor. And because, for example, selecting stocks is hard work, and I'm not going to be doing it because I'm not going to spend 4 hours actually reading financial statements, and because I know, for example, people that are actively holding my money and cost me more money, they're not really going to beat the market, I'm not interested in it. So I'd rather just put my money into index funds, mirror the entire S&P 500, and that's more than good enough for me. Now, you may be wondering, Tommy, isn't that risky? I'll cover that in the second part, but for the most part, investing into the S&P 500 is pretty much diversified, and when you really understand how stocks actually work, you don't really need another investment. Now, you may be wondering, okay, Tommy, how do I invest money, okay? In order to buy stocks, in order to buy index funds, in order to buy bonds or invest into actively held mutual funds, you're going to need a broker. A broker is the middle person or the middle corporation that's going to serve as the middleman between you, a buyer, and a seller somewhere else, okay? Whenever you buy a stock, believe it or not, there's someone else is actually selling. That's the interesting thing about stocks, okay? You think you're making a good investment, but someone thinks they're actually making a good investment by selling it to you. That's kind of crazy, right? But it's how it works. So brokers, they're going to hold on to your money. You can have it there. They hold your investments. You can actually buy and sell when you want to. And the broker I actually use is called Vanguard. I recommend only three. Only three brokers I actually recommend at this very moment, and it's going to be Vanguard, Fidelity, and also Schwab's. And I'm going to tell you exactly why, okay? I care about three things when selecting a broker, and that's going to be size, fees, and also track record. Why is this so important? Well, if you look into 1929 and the Great Depression, when things get very hard and very tough, and business is bad, and people are taking their money out, and the market is crashing, the first companies that go down and sink and lose everything are going to be smaller companies. So investing into companies like these, for example, with Vanguard, Fidelity, and Schwab, that have literally over $1 trillion, I think it is, like under management, which is absolutely insane. I'm not making that number up. You pretty much are safe because during that time period, if that does happen, and hopefully it doesn't while we're alive, these companies are so big and massive and have so much money that they're just going to most likely absorb other small companies, okay? Now, very important you know this, okay? There is insurance. SIPC insurance, if I'm not mistaken, when it comes to stocks. The problem is, just because you have insurance, you don't want to get into a car accident. It's not going to be like, well, I'm insured, I'm going to get the money back tomorrow. Doesn't work like that. If your broker goes broke today, it's not going to be a process of, I'm going to get my money back tomorrow. It might take some time, and that's why I'd rather be invested in big companies. Now, there is another benefit of size and magnitude. It's going to be the fees. When you're managing so much money, charging someone 1% or less than 1% is still millions and millions and millions of dollars. So they don't have to charge you that much money in fees, which is actually a big benefit to us investors. However, if you are using, for example, smaller companies, it might sound like it's not that much money. For example, charging you $1 a month or $5 a month. But $5 a month, 5 times 12 is $60 a year. And if you only have $1,000, that is still a good chunk of your portfolio. So you have to kind of, when you're an investor, you have to look at the small digits, the returns, and you want to be most cost effective. Now, track record is going to be very important. These three companies, Vanguard, Fidelity, and Schwab's, they're all older than I am. They're over 50 years old. They have a track record. They've been around for a long, long time. And when you're trying to invest for your retirement, you want companies that are going to be around for a very long time. Now, how much money do I recommend you actually invest? People are always surprised because they always expect me to say a lot more than I do, but it's going to be about 10% of your net income. Now, there is a reason. When you first start investing, you get really excited and you want to just basically dump all of your money. You want to have a savings rate above 50% and you want to save, invest, and it sounds very attractive until you find out that the only thing when it comes to financial freedom is not just going to be having a lot of money in investments. And investments, the trick is not putting in a lot of money unless you have literally like $1 million or $2 million to invest today, but it's going to be to just stay consistent and let compound interest do its work. Now, if you don't know what compound interest is, it's literally letting your money grow on top of the profits in a sense. So you're gonna make more money as you keep reinvesting the profits. So if you have $100 and you're gonna make 10% a year, well, the first year you made $10. 10% of 100 is $10, right? But the second year, if you left that money together in there, well, you have 111, and 10% of 111 is going to be $11. Okay, so you made 11 instead of 10, and the next year you're actually going to make around $12 or $13, something like that. Okay, but every year you're going to make more and more and more money because you're letting your money grow on top of your money. Your profits earn you money. Also, your capital earns you money. That is the amazing thing about compound interest. So when you're investing, it's not about having a massive lump sum unless you have a lot of money, but it's more about just being consistent overall. So let's say, for example, you're just gonna start investing and you choose to invest 10% of your money, and let's say you make $4,000 a month. Well, that's about $400 every single month. $400 every single month invested across 30 years at an 8% return, that's going to give you a little bit more than $500,000. That is a lot of money, you see. That's the idea. Now, $500,000 to a lot of people when they hear it today, it doesn't sound like much, but that's literally more than, if I'm not mistaken, it's more than 91% of people actually do. Okay, so most people do not have that much money, literally. Okay, so it is a lot of money. You will be part of the 9% of people that have over $500,000. Now, there's something else that you have to know. You're going to have different types of investment accounts. You're going to have, for example, a normal taxable account, which is basically you invest your money, it grows, but when you sell it, you pay taxes on the profits. That is just a normal taxable account. But you also have retirement accounts, and you have individual retirement accounts, or IRA. And you have two types. You have IRA, and you have, for example, also Roth IRA. There's also more, but when it comes to the employer side, I'll go into that in a second. But for the most part, a Roth IRA allows you to invest the money that you got paid, already paid taxes on, and that money grows tax-free. And when you're ready to take the money out, when you meet the qualifications, well, then that money is not taxed. It grows tax-free, you take the money out, all the profits, and you don't get taxed. And that is great. So if you have, for example, $1 million in like 30 years, or $500,000, like I said before, $500,000 in like 30 years, you can take all that money out and you don't pay taxes on the profit, which is actually amazing. But if you had it in a normal brokerage taxable account, you will pay taxes on all the profits. Now, you also have an IRA. A normal IRA, Well, the big benefit is if you deposit, for example, $7,000 this year, you can deduct it from your taxes, meaning you don't actually pay taxes on that money, but it grows tax free. But when it comes to take the money out at a future date, you have to pay taxes then. It's like postponing the taxes. The Roth, you pay taxes today. The IRA, you pay taxes tomorrow. That is the idea. I rather personally the Roth because I really do believe that when I get older, I want all the money possible. I'm not interested in tax benefits today when I'm so young. Now, on top of that, you also have, you probably heard about this, 401k, 403b plan. You also have Roth 401k. In the sense, it's like the same thing, okay? But these are just employer plans. And you might be wondering, Tommy, well, what do I actually invest into, right? Because I know I can have Vanguard or Fidelity or Schwab's, which you recommended, but I can have these types of accounts also. So which account do I actually choose? Well, I recommend this strongly. If you have an employer and your employer is offering you a match, which is called basically like free money, if you invest $1,000, I will match it up to $1,000. I would basically invest the max amount of money to get the full match from my employer because it's basically free money, okay? It's free money to us, but the employer can deduct it from taxes, saves them money, but for the most part, it's an instant return. So we get the max from there, but the rest of my investment money, if I have any left over, I'm gonna put it into a Roth IRA. And then if I max out my Roth IRA, because by the way, Roth individual retirement plans, they do have a cap right now is $7,000. It goes up by around $500 every single year, if I'm not mistaken, but right now it's about like $7,000. So if you basically max that out, which by the way is a lot of money, I will put the rest of the money either into my 401k with the company if it's a good plan, or I would just put it into a normal taxable account. That is the idea overall, okay? So max out the match, then max out the Roth, and if you want to max out the full 401k plan, if you do have a good plan. And when I say a good plan, I mean this, okay? Some employers, there are affiliated with investment companies. So these investment companies may be charging you 1% or 2% or 3%, and it just doesn't make sense because it is just a horrible plan and it's costing you a bunch of money. So instead of doing that, I would just put my money into a taxable account. That is the overall idea. And they may not have good options when it comes to investments either. They might not offer any Vanguard funds. They might just offer, for example, funds that they have, and those might be more expensive, okay? So that's why I say what I say. If you have more questions on that, comment down below, but that's the general idea. Now, for the second part of this video, why do I invest this way? What are my potential profits? What are the risks? And what does history show about this? Now, I kind of hinted and I mentioned before why I pick index funds when it comes to investing, specifically just the S&P 500. But the overall idea is that it's passive, it's easy to invest into, it's low risk, and it doesn't take a lot of work to actually manage it. Now, this basically means that I can expect a good return for the amount of work I'm actually doing. And remember, picking stocks is almost like a full-time job. It takes a lot of time and it is a lot of work. If you don't believe me, read a book called Beating the Street by Peter Lynch. Read The Intelligent Investor also, but you will recognize something that Peter Lynch makes it sound like investing is a very simple thing to actually do, but you notice that everything that Peter Lynch talks about all the time is just investing. He's walking around thinking about stocks. He's always doing math in his head about stocks. He's just always thinking about stocks. Now, what I want to do is literally, I have some surplus cash that I make every single month when I get paid because I don't spend all the money I make. So I want to use that money to make me more money for the future. That's it. I don't want to be, for example, a trillionaire. I don't want to be taking on a lot of work when it comes to stocks. So to me, it just doesn't make sense beneficially, mathematically, time-wise, and everything else, okay? So that's why I invest the way I invest. By the way, I should answer this because this is very important. Tell me, why just the S&P 500? If you want to copy my strategy, you can if you want to, but you have to know why I do it. When I first started investing, I did not start just with the S&P 500. I had the S&P 500. I had some REITs, which are real estate investment trusts. It's you literally being able to invest money in a bunch of different real estate like deals and so on. Okay, so it's pretty cool stuff. But I also had money in small cap investments, like here in the US, like small companies that are bound to grow and you might make some money from that. I also had money internationally in big, large markets overseas. And I even had money in emerging markets outside of the US. Now, that sounds like, Tommy, wow, you are a lot more diversified that way because your money is basically just spread around so many different areas. But the truth is, when you look at the history, when the stock market is down and when things are just terrible overall, everything is going to be down. And here's why, okay? Because our societies, economies are so intertwined. If America fails, it's not just like America's going to fail. A lot of like other industries are going to be affected because we do business worldwide. China is going to be affected, Europe is going to be affected, and even Russia may also be affected. That's the idea. So me just being invested just into the S&P 500, which is literally just the 500 largest companies in the US, when you think about it on a grand scale, it's more than enough because Apple does business everywhere. These companies are intertwined everywhere. And if America fails, we're going to have a lot more issues than me and my investments and my retirement. That can happen, but unlikely, okay? Now, what are the risks, okay, of investing this way? If you choose to invest this way, it sounds like I just told you the risks, but trust me, I have not told you the real risk just yet. It gets worse. It gets scary. And the reason I want to actually put a little fear in you is because everyone just talks about profits when it comes to stocks. And trust me, it's not just all profits. So the main thing is this, guys, okay? Whenever you talk about return, you also have to mention risk because they go hand in hand. Because your risk is going to equal your return. The more risk you take, the higher the return should be. The less risk you take, the lower the return is going to be because your money is more guaranteed. And as investors, we get paid based on the risk we actually take. And the S&P 500 for the past 30 years has averaged about like 8%. Now, something I love to do to kind of make sense of these things is basically, if I want to figure out exactly how long it's going to take me to double my money, all you have to do is this. Just grab the amount of money that you're actually going to be making per year and just divide it by 72. So for example, the number 72 divided by 8%, because again, that's the average return the S&P 500 has been making. So that's how much I expect to make from my portfolio. So when I divide those two numbers, I basically get 9 years. Every 9 years, if everything goes according to plan, I'm going to be doubling and doubling and doubling my money. I mean, that is just amazing. You can actually shoot for like higher returns. And by the way, it's not like I make exactly 8%. That's just an average. But I have noticed I've been making like 10% and 11%. But once you basically take out inflation and fees and taxes, you're left with like just about 8%. When it comes to returns, you don't want to be greedy. You don't want to say, I'm going to make 10% and I'm going to basically average things out to that, because if you make less, you're going to be shocked how much just a 2% difference can mean when it comes to 30 years worth of saving up for retirement. So I like to be a little bit pessimistic when it comes to my returns, and that's what I use, like 8%. That's the idea. And remember, whenever you're going to be investing into stocks, you want to compare it to bonds. Here's an example because I really want to drive this home. Bonds always underperform stocks. That is true over the long term, but it doesn't always make sense to buy stocks over bonds. It sounds like I'm saying complete nonsense, right? Well, Tommy, if bonds always underperform stocks, it always makes sense to buy stocks. But yes, notice what I said, over the long run. And the long run can be like 30 years or 40 years until this true becomes true, okay? So if you're in your 70s, you don't want to do that, right? You probably just want to buy bonds and just stick to having, for example, a fixed amount of income. Now, here's why this is so important. So let's say I can make 8% by investing into the S&P 500, but the government basically issues out a bond paying me 5% or 6% risk-free. Which one do I take? The 8% stock or for example, that 6% or 5% bond? The answer is, for me personally, I would probably take the bond in a heartbeat. And it's because it's an appropriate amount of return for a long-term perspective when it comes to investing without any risk whatsoever. Now, again, I say no risks, but there is risk involved even when buying government bonds. So here are the risks you should actually just be privy to. You should know about this, okay? So we had basically 5 major crashes so far in our history. We had the 1929 crash, the 1987 crash, the 2000 crash, the 2008 crash, and also the 2020 crash. And that one you probably lived through, because I'm pretty sure you're not 6 years old or 5 years old watching this video. But the general idea is this. When I tell you, you don't know how bad things can get, you don't know how bad things can get, okay? I recommend you read a book called Great Depression Diaries by Benjamin Roth. That book is just amazing because it tells you how bad things can get as far as economy goes, okay? So here's a massive amount of risk that you need to know about, okay? So first of all, when you think about a bond, it's like the credits of the entire country, right? As far as being issued, for example, a government bond, all right? Not talking about any corporate bonds or anything like that. But when the government issues out a bond, if they can't pay you, it means the credit worthiness of the country is basically done for. But a country can actually do something pretty insane. If they owe a lot of money in bonds and it's too much money, what they can actually do is they can print a lot of money and cause inflation. So your $1,000 you actually lent to the government is going to be worth a lot less. So the government is going to benefit greatly from this. Here's an example, okay? Let's say you owe $100,000 in student loan debt today. You know exactly what you could actually buy with $100,000, right? A lot of stuff. However, if the government actually chooses to print a bunch of money and we have hyperinflation and money loses its value by 50%, then effectively that $100,000 is only worth 50K in today's money after all the money has been printed. So you can pay back the $100,000 with literally the 50K equivalent, which basically means your debt becomes cheaper, which for you is a big benefit, but for your student loan provider sucks. That is the idea. Inflation is terrible. However, you could also experience deflation. Deflation is when the government chooses to actually basically cut out circulation of new money in the economy, which basically makes the current money we have now more valuable. But it also means your debt also has more value. It becomes a lot more heavy. But that's not the only risk when it comes to investing over the long run. It is the extended down market. So in 1929, when that crash happened, it took under like 30 years or a little bit over 20 years for the market to recover to the original peaks before the crash. What that basically means is this in common English. If you had $1 million invested in 1929, well, in that year, you probably would have lost a third of all your money. So you would have been left with literally like about like $777,000, something like that. But then a few years later, you would only have, for example, a third of that. So now you would be left with like around $25 or $250,000, literally like 1/4 of the original value. Now you might say, Tommy, well, going from $1 million to $250,000, well, that just sucks, but it sounds like it's a sweet deal when it comes to investing more money and becoming wealthy. Here's the problem. That lasted over 20 years. So imagine how old you're going to be 20 years while waiting for the market to recover. So when I tell you things can get bad, things can get really bad. And here's even more extremes, okay? If you read the book Depression Diaries, you will see, for example, how apples and just goods overall, they became dirt cheap. But no one could buy them because no one had any money. You had women and men that literally offered, for example, to marry each other basically for money. Like, hey, here's $5,000. I'm offering myself for marriage if you want to. That's how bad things can actually get. Lawyers, which is basically like the middle class in a way, right? These people were making like pennies People that were real estate investors, they basically weren't making any money whatsoever, and they couldn't afford to even pay the taxes, and they lost the properties, okay? When I tell you, investing is a risky business, it is a risky business. And that's why you have to be aware of the risk when it comes to investing. There are no risk-free investments. When the economy can be manipulated, you can literally lose everything you have overnight. That's why you want to be very careful, and you want to know exactly what you're investing into. So again, I highly recommend you read Depression Diaries, The Great Depression Diaries by Benjamin Roth. It is a phenomenal book, and it will put a healthy dose of fear in you. And by the way, you can copy the way I invest. You can know investment basics, but if you don't know why you invest the way you invest, when times get hard and you have to buckle up, you're probably going to sell everything you have and you're going to lose all your money. That's why you have to have conviction when you're actually making investments. Now, here's the third part of this video, and it's going to be the perfect investment strategy that I found for myself so far. Now, when it comes to investing, as you can tell by watching this video up to this point, there are a lot of things you can't control. You can't control the market crashing and staying down for decades. You can't control, for example, the United States basically just falling apart and defaulting on all the loans. You can't control inflation. You can't control deflation. You can't control a lot of things. But there are some things you can control that will make a big difference when it comes to your investment life. The very first one is going to be controlling your costs of overhead. Now, what that basically means is everyone has overhead. It's the amount of money it takes for you to actually run your life. The lower this amount is, the more powerful you're actually going to be. It kind of sounds strange because we always think we need to spend a lot of money, but the less money you actually need to live is going to basically make a big difference, okay? So here are some ways I've actually managed to lower my cost of living. Number one is I don't have any consumer debt. I have zero. I don't even have a credit card, okay? Because it doesn't make sense, because even then I would have to find money every single month to pay student loan debt, to pay credit card debt, to pay for this, to pay for that. I just don't have any debt whatsoever when it comes to consumer debt. Number two, I saved up 6 months worth of my emergency fund. So I know how much money I need per month to actually live, involving shelter, utilities, groceries, transportation. And I basically have times 6 of that amount saved up. So that way I don't have to worry about that. Third, simultaneously, I've been able to basically keep investing 10% while basically having money on the side to purchase a home. Now, here's how I recommend you actually purchase a home. Save up at least 10 to 20% down for the down payment. And on top of that, buy a home on a 15-year mortgage, and buy a home where the cost of actually owning it, when it comes to the mortgage, the taxes, the insurance, the maintenance, is no more than 33% of your net monthly income. What's going to happen is going to basically limit you to a much smaller home in a normal neighborhood, nothing fancy, but you're going to be able to pay it off faster. But number four is this: if you've been investing 10% simultaneously while trying to pay off your mortgage faster, in 15 years, if you invest $400, you'll have about, for example, per month at 8%, you'll have about $140,000. But on top of that, you'll also have a paid off home and over $1,000 that you don't have to go out there and find anymore for paying a mortgage. Just puts you in a much better position. So here's an example. If the market goes down, if you lose your job, something crazy happens, guess what? You only have to find the money to pay the taxes and the insurance, to pay utilities, to pay the groceries, and to pay transportation. That is it. It's a massive difference, and it gives you a lot more control because you need a lot less than everyone else, so you don't have to worry about finding a job that pays a lot of money. But if your cost of living is high, you'll always have a problem because you need to find a lot of money to live the way you actually want to live. Now, the second strategy is actually going to be doing dollar cost average. That is so important. And here's why. When I first started investing, my main worry was always, hey, am I buying too high? Are prices too expensive now? Or am I buying and it's actually not low enough? So when you do dollar cost average, and I tell you the average return is 8% on the market overall, if you buy in a lump sum, well, you might buy when the market is high and maybe it might go down and now you have to keep waiting for years for it to recover. But if instead of doing that, you just invest $400 or the same amount of money every single month, at the end of the year, do you know what price you actually bought at? You bought at the average price for the year. So you don't have to worry about the highs and you don't have to worry about the lows because you're constantly buying. Thus, you're getting the average price. That makes a massive difference instead of investing, for example, in a lump sum. In the end, in 20, 30 years, they all basically look alike, but in between, it makes a big difference when you are basically investing every single month that way. Now, the third thing that makes a lot of sense for this strategy is going to be following the 4% rule. The 4% rule is actually a retirement strategy, and it basically just means you want to live off 4% of your investments. So the goal is to have enough money invested so you can live off 4%. Now, this all comes into play to how I have my investments pay all of my bills. So here's a fun way for you to do it right now. It's a fun calculation. It's easy to do. So I can spend literally about $1,200 a month, and I can have a pretty good life the way I live right now, okay? With my wife in an apartment, we're fine. Now, here's what I want to do. I want to multiply my monthly budget by 12, okay? That's going to be $14,400 every single year. Now, to find out how much money I need to have invested, I just need to multiply it by 25. So multiply by 25, and it shows me right here, hey, Tommy, you need about $360,000 invested. And 4% of $360,000 is going to equal that same 14,400, you see? So instead of me having you multiplication with percentages, just multiply by 25 and you're going to have the same effect. Now for me, that means I only need to have invested 360,000. Now, do you know how much money I would have needed if I stayed in the United States, spending about $4,000 a month? Well, I would have needed about $1.2 million, and that can take a long time. Decades, okay? So I rather live here in Dominican Republic and save a lot of time and money and not have to work as hard, okay? For the most part, I'm just being honest. You can make these choices too. And it doesn't have to be as extreme as coming to a third world country like I did because I'm from here. But if you live in New York, you can live in Tampa. If you live in Tampa, you can live in Texas. There are several places in the United States where you can actually live to, like Ohio, where you can find like communities that are actually good, solid, and safe that don't cost that much money for you to actually live. One thing I see a lot of folks doing is leaving New York and going to Pennsylvania. And basically, instead of paying $2,000-$3,000 in rent, they only pay $800 for a full-blown house over there. And that saves them a lot of money. But this usually involves a massive commute that I'm not a fan of. So I still don't do that, okay? Because I don't want to waste 2-3 hours of my life in a car daily. It's insane. I just wouldn't do it, okay? But there are ways to find from home work with great skills. So that's one approach to actually go about it. So that's it. If you actually want to pay your bills with investments, that shows you exactly how to do it. Now, here's something else I want to teach you because this is going to change your life forever. And it's basically breaking down all of your bills. So do me this favor, okay? This is what you want to do. You want to write on one side the names of all of your bills, okay? So when it comes to your rent, when it comes to internet bill, your PlayStation subscriptions, your haircuts, all the stuff you spend money on. If you don't know what you spend money on, check your credit card if you have one of those, check your debit cards if you have one of those, just check where you spend your money and where the history is at. So have the names, have the amount you spend per month, multiply that amount by 12 so you know exactly how much it costs you annually, and then multiply that by 25 so you know how much money you need to have invested to cover all of it. So here's an example, okay? when I was living in New York, I had an internet plan with Verizon. I think it was like a gigabyte connection, something like that. It was like 1,000 megabytes, which is absolutely crazy. And I was paying about $100. Okay, so $100 for this internet plan multiplied by 12. Well, that's going to be $1,200. Multiply that by 25. That's going to be $30,000. That basically means if I want money in investments to cover that bill, to cover my bills, I'm going to need $30,000. To me, that was like, that's a lot of money. I don't want to spend $30,000 just to pay some Verizon bill. So what I did was, or internet bill, because a lot of us have that connection. But so what I did was I changed from a $100 plan to a $40 plan. And Verizon offers a great plan. So the one I got was like 300 megabytes, I think it was, which is actually still great. So 40 times 12 to get the annual, multiply by 25 to get how much money I would need invested. That's going to be $12,000. That saves me roughly $18,000 that I don't need to have any more investment. So it's a great way I approach investments and bills because I don't want to have any fat when it comes to my costs, because why have that? Now, here's a subject that I want to mention here, but it's completely like if you want to. If you want to, you can do this. If you don't want to, you don't have to do this. It is optional, okay? But tell me, if I do all this correctly and I do get to an amount where I don't have to worry about my bills anymore because my investments pay for them, when do I stop investing and do I keep money in cash? Well, the first thing is I don't recommend you stop investing at least until you have twice or three times the amount of money you actually need. So if you need $1 million, you need 2 million to stop investing, okay? If you need 500K, you need 1 million. And the reason is because, again, if the market crashes, buy it a lot, well, and it stays there down for a long time, well, if you needed 500K and you have 1 million and it went down by half, you are still going to be good. But if you needed 500K invested and it went down to 200K, well, now your income is cut down by more than half. You're in trouble. You need to go out there and find a job, okay? So stop investing maybe when you have 2 to 3 times more, or if you have like a lot of money and you know like it's enough, okay? But for most people, it just doesn't make sense to ever stop investing. So if you're gonna invest, just invest like 10% and keep doing that and keep doing that and keep doing that. Just keep basically having more money in there. However, though, what if you are investing, but you have some extra money? Do you invest the bulk of that money? Or do you have fun with that money? The actual answer is there are more answers, okay? So one big question is, do I keep any money in cash? The answer is yes, you can actually do that, but it is optional. Again, now, when you have money in cash, it does great things for you psychologically. One, instead of having 6 months worth of emergencies, you can build it up to a year or up to 5 years, in my opinion. But for me, that would be basically like $60,000 to cover 5 years worth of expenses, which is a lot of money, but you can do it without losing to inflation by investing in TIPS. TIPS are treasury issued securities that are inflation protected. All right. So it's like a security issued by the government that protects you against inflation. So if inflation is 3% this year, it will make you 3%. And that way you keep consistent with what inflation is and the value of your money. You can do that. Or you can put it in a high yield savings accounts that basically beats inflation. That way you have that money and it's good to go. But another option is that basically you may want some cash on hand to actually have for opportunities. This is dangerous, okay? It shouldn't stop you from investing consistently, but having some cash on hand so if things go down, you can invest is also not a bad idea. Here's an example, okay? In 1929, prices were basically dirt cheap. Stocks were like worth like a fourth of what they were originally. A fourth, this means basically 25% of the original value. That means something was $100, you could buy for 25, which is basically super cheap. But if you didn't have any money to take advantage of the opportunity, it wouldn't make a difference. You see what I'm saying? But having cash on hand can make a difference. The problem is if you're not investing in hopes for the market to go down, you may be out of the market for decades. And history shows and math shows that you are still not going to beat someone else that was just basically doing dollar cost average. That's why dollar cost average is so powerful. But if you are doing dollar cost average and you do have cash on hand for opportunities, that is also not a bad thing. Now, would you keep the money in bonds, in tips, in a high yield savings, or for example, in a CD or even gold? The answer is these are all options that you need to explore yourself, but I personally wouldn't have my money in a CD. I've done that before and I had to break it, which was a terrible idea. I've also haven't had my money in any like gold, but I don't like the gold idea. The problem with gold is that literally gold doesn't do anything. Gold just has a value because we chosen to give it a value. If we choose not to give it a value, it is done for, okay? It's just that simple. But if I put my money in tips, it's insured against inflation. If I put my money, for example, in a high yield savings and it's beating inflation, then I feel pretty good about that. But during times of like hyperinflation, having it in tips probably makes sense. But I want you to remember there are just a lot of things and a lot of variables you can't control, but control the ones you can control. Now, guys, that is basically it for this video. I hope you actually learned a lot. I hope you walked out of here just saying like, I didn't know this and now I do. I told you if you made it all the way to the end, you would know more than 90% of investors out there that just basically say, hey, here's a stock. Used to be this price, I'm gonna buy now. You leave with a strategy, okay? Now to summarize the strategy in full, I have no debt. I have a fully funded emergency account. I invest 10%. I try to do that every single month. And I basically have money to purchase a home. But if I didn't have money to purchase a home in cash, I would just basically buy a home the way I told you and continue investing. And keeping my cost of living low is perfect. My only investment is just into the S&P 500. I invest with the broker called Vanguard, and I do have money in high yield savings preferably. I don't like having my money, for example, in standard checkings accounts. And one piece of advice I would love to leave you with is this. If you are ready to invest, I recommend before you start investing, you're debt free and you have a fully funded account when it comes to emergencies. But if you are ready to invest, set it up automatically. Do not think about it. Do not make it emotional. So if you're going to be investing $400, have that $400 automatically taken from your check-ins and invested into your account. And Vanguard does do that, by the way, but that way you don't have to think about it whatsoever. Guys, thanks for watching this video. I hope it helps you. If you like these long format videos, let me know in the comments down below and I'll keep making more. And see you guys next time. Subscribe and like this video. Tommy Bryson out.